Welcome for another report about the week ahead. Before we start, I'm going to leave some time for the risk warning to be read. Now, we're leaving behind us a turbulent week, which tended to increase volatility in the market. We take a look at what next week has in store for the markets. On the monetary front, a series of interest rate decisions are expected to keep the attention of traders alive. We highlight the release of RPNZ's, BOC's, and from Turkey, CBRT's interest rate decisions on Wednesday, as well as BOJ's interest rate decision on Friday. As for financial releases, we have a loaded week ahead of us with high-impact financial data due out. On Monday, we note from Japan the corporate goods prices for June, as well as the machinery orders for May. On Tuesday, we highlight China's trade data for June and the US CPI rates for June as well. On Wednesday, we get UK's and Sweden's CPI rates for June and Eurozone's industrial production growth rate for May. On Thursday, maybe the most significant day of the week, we get Australia's employment data for June, China's industrial output for June, the GDP rate for Q2, UK's employment data for May, and in the American session, among others, we get from the US the weekly initial jobless claims figure. That would provide traders a wide spectrum of trading opportunities within the same day. Finally, on Friday, we note New Zealand CPI rate for Q2 and from the US, the retail sales growth rate for June. Now, with no time to waste, we move to USDs for our chart. This is Euro USD for our chart. The US dollar seems to be edging higher for the week against a basket of its counterparts. It should be noted that to the upside, we have noted the R1 1.1885 resistance line, which was also tested in the previous week. Higher than that would be the 1.1995 and higher than that the 1.2090. Now to the downside, we note the 1.1785, which was tested practically 2 days ago. Lower than that, the 1.1695, and even lower, the 1.1605. The direction for the time being seems to be sideways, especially as the downward trend line was broken, and the pair remains within the boundaries of the 1.1885 and the 1.1785. Moving now to USD's fundamentals. Fundamentals surrounding the USD seemed at some point during the week to be tilting towards a more risk-off segment of the market, which weakened the USD, given also the drop of US yields. Worries of the market tended to turn from inflation towards growth and the tightening of the US employment market. On the monetary front, it should be noted that the minutes of the Fed's mid-June meeting reaffirmed the bank's intentions for tapering its assets purchases as soon as this year. Fed policymakers seem to be of the opinion that substantial further progress on economic recovery was generally seen as not having yet been met. Yet some policymakers expect the economic recovery to continue, and the bank must be ready to act if inflation or other upside risks materialize. We expect that next week we may see the market turning its attention towards inflationary pressures in the US economy, given also the release of the US CPI rates for June on Tuesday. Now, should the rates accelerate, reaching new 12-year highs on a year-on-year level, we may see the argument for a tightening of the Fed's monetary policy strengthening further, thus providing some support for the greenback. Other notable financial releases we have in the coming week are on Thursday, the New York Fed manufacturing for July, the weekly initial jobless claims figure, the Philly Fed Business Index for July, and the industrial production growth rate for June, while on Friday we get the US retail sales growth rate and the preliminary University of Michigan consumer sentiment for July. Moving now to cable, GBP USD in a sideways motion. As a support line, we would first note the 1.3670, below that the 1.3525, and the lowest level noted would be the 1.3350. Now to the upside, we have the 1.3845, which was being tested a couple of times in the past week. Higher than that would be the 1.3990, which was tested on the 22nd of June, and even higher than that, the 1.4145. Moving with a sideways motion. The pair seems to be remaining within the boundaries of the 1.3845 and the 1.3670. Moving now to the pound's fundamentals. Sterling weakened against safe haven CHF and JPY, to a less extent against the US, and remained relatively stable against a single currency. It should be noted that the pound tended to gain during the week, as it was announced that social distancing measures are to be lifted on the 19th of July. On the other hand, the number of new COVID cases is on the rise, creating some doubts on whether the measures are to be actually lifted on the mentioned date. At the same time, it should be noted that the services sector final PMI reading for June was better than expected and also tended to improve the outlook for UK's economy, as it would imply that economic activity expanded faster than expected in the crucial services sector. On the other hand, UK's GDP rates and manufacturing output came out lower than expected on a month-on-month level for May, spreading worries among pound traders. On the monetary front, we keep in mind BOE Governor Bailey's comments last week that the market should not overreact on a temporary jump in inflation, especially given that UK's inflation measures for June are due out on Wednesday. On Thursday, we note the release of UK's employment data for May. Moving now to the Japanese yen, and this would be USD JPY for our chart. Note how the pair has a downward trend, which practically is currently threatening the 109.90 support line, which we have noted. Lower than that would be the 109.25, which found considerable support for the pair on the 8th and 9th of June. And lower than that would be the 108.45. To the upside, we note the 110.90, which provided resistance and practically reversed the upside motion of the pair on the 24th of June. And higher than that would be the 111.70, which reversed the pair's upward motion around the 1st to the 2nd of July. Higher than that, we would note the 112.25. Now, for the time being, we maintain a bearish outlook for the pair, and as long as it remains below the downward trend line, which has been formed since the beginning of July practically. Moving now to JPY's fundamentals. JPY seems about to end one of its best weeks against the USD since September last year. Overall, safe haven flows tended to support the Japanese currency as risk-off sentiment kept strengthening and at the same time had an adverse effect on riskier assets such as stocks or commodity currencies. Fundamentally, we must also note that news about the Olympics to be held without spectators tended to increase the market's worries. Headlines broke out after Japan declared a state of emergency amid rising COVID-19 cases in the country. On the monetary front, we highlight BOJ's interest rate decision on Friday. The bank is widely expected to remain on hold, keeping interest rates at minus 0.10%. It's characteristic that currently JPY ORS implied probability of 92.57% for such a scenario to materialize. Overall, we expect nothing new, with the bank probably maintaining a clearly dovish tone. One highlight could be whether the bank is to cut back on its economic growth rate projection or not, which could enhance its dovishness even further. As for financial releases, JPY traders are to have an early start next week with the corporate goods prices for June and the machinery orders growth rate for May due out on Monday's Asian session. Moving now to NZD, and this would be NZD USD for our chart. Note how the pair has been dropping. That has been ongoing since around the 6th of July. A clear downward trend line has been formed. Specific levels to keep an eye out would be the 0.6985, which was just tested today. Higher than that would be the 0.7040, which was also tested around the 6th of July, maybe even the 7th. Even higher than that would be the 0.7095, which was also tested twice even, if not thrice. To the downside, we would note the 0.6935, which was tested once the day before and twice around the 18th of June. Even lower than that would be the 0.6875 and lower than that the 0.6815 as the lowest level noted on the chart. Once again, a downward trend line seems to be guiding the pair, hence we tend to maintain a bearish outlook as long as it remains below the pre-mentioned trend line. Moving now to NZD's fundamentals, the Kiwi tended to weaken against the USD, yet against the AUD, NZD bears seem to be more restrained. As a commodity currency, Kiwi remained rather sensitive to the rate of the global economic recovery, and the worries that sparked recently seem to weigh on it. Back home, the number of new daily cases seems to remain at rather low levels, which could be providing some comfort. It's characteristic of New Zealand's cautiousness that Prime Minister Jacinda Ardern stated that New Zealand is not willing to risk UK-style live with COVID policy. On the monetary front, we highlight RBNZ's interest rate decision on Wednesday. The bank is expected to remain on hold at 0.25%, and currently NZD-OIS imply a probability of 97.71% for such a scenario to materialize. The interesting part of the decision, though, may lay with the bank's QE program. It should be noted that a recent survey among businesses showed to be a rather strong, which provided a boost for RBNZ's confidence, which in turn may lead to a tapering of the bank's QE program. Also, analysts tend to highlight the possibility of the bank hiking rates in November. Both elements, if combined with a tone of confidence in the accompanying statement, may very well provide some support for the Kiwi. As for financial releases, we note New Zealand CPI rate for Q2 on Friday's Asian session. Moving now to the Aussie, and this would be AUD-USDs for our chart. Note how the pair's price action has broken the downward trend line guiding the pair practically during today's late European session, and the pair has jumped above the 0.7465, which was turned from resistance to support now. Specific levels to keep an eye out would be definitely the 0.7465, which was tested in the past. Lower than that would be the 0.74, and even lower would be the 0.7335. To the upside, we would note the 0.7530. Higher than that, the 0.7595, which was tested twice, and even higher than that, the 0.7685. For the time being, we maintain a sideways bias. However, we wouldn't be surprised to see the bulls jumping out. I would highlight, though, the RSI indicator, which is just at the reading of 50, implying a rather indecisive market for now. Moving now to AUD's fundamentals. The Aussie seems to have lost ground against the USD for a second consecutive week. The Aussie was in full retreat yesterday, as risk aversion was more than evident in the global markets, and worse grew as Sydney tended to tighten its lockdown measures as an outbreak of the Delta variant could get out of control. Traders tended also to worry about the adverse effects of the path of the pandemic on Australia's economic outlook, but also on a global level, as Australia is an exporter of raw materials, and implied that traders were more worried about slowing growth rather than an accelerating inflation. At the same time, RBA's persistence to hike rates in 2024 rather than at an earlier date tended to weigh on the Aussie, highlighting the interest rate differential outlook of the Australian central bank with others, not excluding the Fed. As for financial releases, next week we get an interesting mix of Australian and Chinese data, which could keep Aussie traders on the edge of their seats. On Tuesday, we get China's trade data, with Aussie traders looking at the import growth rate as Australian exports are of high amount in iron ore to China, among with other materials. On Thursday, we get Australia's employment data for June and China's GDP and industrial output growth rate for the same month. We tend to place special emphasis on China's GDP rate as it may act as a barometer for the recovery of the global economy, albeit Australia's employment data may have most of the market's reaction for the Aussie. Moving now to the CAD. The Canadian dollar against the US dollar, it's USD CAD, the pair we're looking at. It's the 4-hour chart. Now, it had a clear upward trend line, however, it was broken today, earlier today. Hence, we switch our upward outlook, a bullish outlook, in favor of a bias for a sideways movement, at least temporarily, until the pair decides on the direction of its next leg. Now, specific levels to keep an eye out would be the 1.2470, which was tested extensively near the mid of June, actually around the 18th to the 19th of June. Lower than that would be the 1.24, also extensively tested before broken. And lower than that would be the 1.2320, which was tested in the past few days, actually at the beginning of July, 2nd to the 3rd of the month. To the upside, we note the 1.2560, higher than that, the 1.2650, and the highest level noted would be the 1.2745. Now, moving to CAD's fundamentals, have a lot to do also with oil. Looney bears dominated the CAD's direction against the USD, as we have seen in the past week once again. The recent drop of oil prices tended to mark the end of bulls' dominance in the oil market for the past 6 weeks, and CAD traders took notice, given that Canada is a major oil-producing country. Now, the disagreement between OPEC Plus members, and specifically Saudi Arabia and the United Arab Emirates, about future oil output levels practically cancelled negotiations, leaving oil traders with the worries whether United Arab Emirates is about to increase production levels and supply, thus weakening oil prices. Now, the developments had an adverse effect on the CAD as well, as oil prices dropped even despite US oil reserves falling due to the tight conditions in the US oil market. Now, next week, we expect CAD traders to keep an eye out for BOC's interest rate decision on Wednesday, and the bank is expected to remain on hold at 0.25%, and CAD OIS imply a probability of 89.22% for such a scenario to materialize at the moment. Now, analysts are highlighting, though, the possibility of the bank tapering its QE program, and such a scenario, if combined with a rather hawkish tone, may provide some support for the CAD. As for financial releases, CAD traders are to have a rather empty calendar for the coming week, maybe with the exception of Canada's manufacturing sales growth rate for May on Wednesday, yet even that may be overshadowed by BOC's rate decision the same day, while on Friday we get Canada's number of house starts for June on an annualized basis. Now, before leaving you, as a general comment and as a closure, overall we expect the USD to maintain the initiative over other currencies in the coming week. It should be noted, though, that on Tuesday and Thursday, the intensity of USD's influence in the FX market is expected to be magnified, as there are expected to be multiple high-impact financial releases. Should the risk of sentiment of the market, though, continue to be cautious in the coming week, we may see the safe havens gaining, while on the flip side, commodity currencies could weaken. Beyond the FX market, it should be noted that US stock markets seem about to end the week with little change, as the markets seem to maintain a wait-and-see position. Should the market's worries for a possible slowdown of growth increase, it could weaken stock markets, as could also expectations for an acceleration of the US inflation rates. On the other hand, the path of the US yields should not be underestimated as a possible driver for the markets, as should they continue to drop, we may see US stock markets, especially NASDAQ, gaining, as could also stock prices. It should be noted that in the current week, the precious metals ascent has continued for a third week in a row, and we are quite curious to see whether this is going to be maintained in the coming week as well. From all of us here at IronFX, thank you for watching and best wishes for solid trading.